Hi, this is Tony Harris with Performance Trust Investment Advisors in Chicago. I'm on the floor of the CME Group. This morning we got surprisingly good Empire manufacturing data. The index came in at about 10. The market was looking for -2. On the flip side, we also got industrial production numbers that came in slightly negative. The market was looking for something slightly positive. Those two basically cancel each other out. We're still in the ranges we've seen in February for safe haven assets. The U.S. 10-year Treasury is probably about 2% right now. It's been ranging 195 to 203, a pretty tight range for all of February. Let's talk a little bit about non-agency mortgage-backed securities. Last week we talked about the ABX subprime index. We talked about how it was weakening and how there were some volatile trading days. That has since seeped into the cash markets in non-agencies. You have dealers talking last cash flow subprimes down about 2 points or so over the last week. In terms of the cleaner bonds like prime and alt-A fixed rate bonds, those are down about a half point to a point. Some of the traditional signs of weakness that we typically look for, we are starting to see in terms of bonds that come out for bid. We're seeing a higher percentage of bonds that do not trade. In our market, sellers can come out, they can put their bonds out for bid. To the extent that they want to hit the high bid, they can do that, or they can choose not to sell those bonds. To the extent you see a higher percentage of bonds not trading, that means that the buyer and seller's expectation of price is widening out, and that usually indicates softness ahead. In terms of the dealers, they've been shedding inventory all of February. They've shed about 1.3 billion in inventory over the month. That's not necessarily a bad thing over the long term. However, in the short run, they had been the marginal taker of risk in the market, and to the extent that they're not acting in that role, you can see softness in prices. This also means that we've seen widening bid-ask spreads. So to the extent that you have lower levels out there in the market to take advantage of, it's not necessarily easy to source that paper. So what are we doing with all this? Well, we don't see any fundamental reason why non-agency paper should be selling off. The home prices in the United States continue to move forward and show good momentum there. The most recent employment data in terms of the initial jobless claims yesterday was very strong, so there's no fundamental reason to be selling off. So what we're doing is we're taking advantage of this this lower price environment that we're seeing. We're taking advantage and buying some more of the more credit risk type of instruments. We're not buying subprime, but we're buying some of the more credit risky alt-A fixed rate cash flows to try to take advantage of these lower prices. This is Tony Harris with Performance Trust Investment Advisors in Chicago. Have a great day. Thank you.